Market volatility could stick around for a while. What's the best way to position your portfolio to weather these risks? Let's ask money manager Richard Bernstein. Richard Bernstein, it is so good to have you on Barron's Roundtable. Appreciate your coming on.
Yeah, thanks for having me. Thanks for the invitation.
So in your view, the Federal Reserve has its thumb on the scale of the weighing machine that is the stock market. Can you explain what you mean by that?
Yeah, so I think we're in a situation where the Fed has really dominated the long end of the yield curve for quite some time, right? Quantitative easing, buying long-term bonds. But what people don't realize is that at its peak, the Fed owned over 50% of the 10 to 20-year Treasury market. So what that did was it distorted long-term interest rates, and that was their goal. However, what they didn't anticipate, I don't think, is that they would distort the valuations of every asset that's priced off the long end of the yield curve. So we have extremely overvalued assets, whether it's tech, innovation, disruption, cryptocurrencies, anything like that is a direct result of the Fed basically distorting the long end of the yield curve.
And that's really an important point because a lot of people say, hey, look, the 10-year's only yielding, what, 1.7 something, so there's not too much growth or inflation price in the market. You're saying that's not a real signal. But I want you to step back and comment on that, but give us a little historical context here. You know, we've had a tailwind in both the stock and the bond market for literally 40 years, and maybe that's going away.
Yeah, so I think that, you know, is the bond market telling you anything? I'm not so sure because I think the Fed has gagged it, right? So when people say that, you know, it's only 170 or 180 on the 10-year, how much inflation can there be? How much growth can there be? Well, I think it's because the Fed's not letting it talk. But your point's very important in terms of the 40-year tailwind, where we've had 40 years of disinflation, 40 years of downward sloping interest rates, and that gave rise to a lot of the things and a lot of the sectors of the stock market, the themes that have outperformed that people now consider normal. The problem is that inflation backdrop is starting to change, right? We're not going back to the 1970s, but it is indeed changing, which may mean that a lot of portfolio constructions may now be inappropriate for the next 1, 3, 5, 10 years.
In particular, you think that the growth stocks that have been powering this market higher for, what, 12 years now, that they could be in a really bad position for this outlook you're painting?
Absolutely. So let's assume that the Fed is going to extract themselves from the long end of the yield curve. As they've said, they're going to sell 10 and 20-year bonds, and that would mean that rates go up. What that means is that anything that is high PE is probably at risk. In other words, a high price-earnings ratio. Because we know as interest rates fall, PE ratios go up. It's like a seesaw back and forth. So if long-term interest rates are going to go up, those growth stocks are going to have the biggest risk because they don't have any incremental near-term earnings growth to offset the incremental negative of rising rates. Cyclicals, on the other hand, probably would.
Okay, so cyclicals would then be one opportunity for investors right now, a way you ought to shift your portfolio. I mean, even if you just own an index fund, you're really heavy in these big tech stocks. Tell us what a portfolio for the coming decade ought to look like.
So from my perspective, I think it should be kind of in pro-inflation assets. This is an asset class that investors are universally underway, whether that be pensions, endowments, foundations, family offices, high net worth, individuals. Everybody is underway pro-inflation assets. So what are pro-inflation assets? Energy, materials, industrials, high-yield bonds, emerging markets tied to commodities, gold. Notice nothing I'm saying is like a growth-oriented investment because that's what doesn't work in a rising inflation, rising interest rate environment.
What about looking overseas? Obviously, the U.S. stock market powered by these big tech stocks have done better than the rest of the world. Is it time to look abroad?
Yeah, I think so. And it's kind of funny. You know, if you go back 10, 11 years ago, nobody wanted to invest in the United States. If you wanted growth, I'm not sure people knew what that was, but if they wanted growth, you had to invest in the emerging markets. Well, the emerging markets then underperformed the United States for a decade. The United States outperformed, and now there's a complete 180. Everybody says, where else would you invest other than the United States? That comes at a point in time where fundamentals are actually improving outside the United States, and the markets are an awful lot cheaper. They're much more undervalued. So when you have cheaper markets and improving fundamentals, historically that said there's opportunities.
And add to that, nobody wants to invest there, which means you probably should. Richard Bernstein, thanks a lot.
Exactly. Yeah, thanks for having me.